I'm all about keeping this informal. It's lunch, you're eating. If you need to get up, take a break, that's fine, absolutely. And as I go through this, if you have any questions or observations, don't hesitate to stop me, and we can have a little bit of dialogue about that. So Ziegler is known in this circle certainly as a senior living and investment banking firm, but we also have a number of different pockets in the not-for-profit sectors that we provide support services for from a finance standpoint, and also, again, data, trends, and information. And you can see here that closely related to what all of you do, healthcare. So we do work with hospitals, health systems. We do have an FHA HUD practice as well, so any of you in the room who offer affordable housing services, we partner with those providers as well. Higher education, charter schools, so it runs the gamut, and senior living, again, is what most of you are familiar with. We are a national practice, so I'll talk a little bit about some Florida-specific things, but also very much give that big picture perspective on what we're seeing among your peers throughout the country, and you can just see the breakdown there. This is a resource for all of you, just so you have this at your fingertips. This is all research that we provide to the industry. So this is sort of my job description. Doesn't it look so simple, one little page? We get inquiries on a pretty regular basis, and it might come through one of our bankers, it might come directly to me, but I get emails that say, hey, do you have information on this or data on that? I'm speaking to my board, or I have to go to maybe my resident committee, or whatever it may be across a variety of topics. Definitely see us as a resource around that. Again, there are published lists and documents that we put out there in our Z News or through Leading Age in our partnership with them, but there are many lists that we just have internally that we have as resources for all of you. So this is just a sampling of some of the different things that we provide. A number of the slides that I'll show today talk about the Leading Age Ziegler 100 document. I'll share some information on that, and we're at the end stages of collecting the data for the 2014 survey, and we have a sneak peek at some of the information from a preliminary standpoint with that. So some of the table of contents. I want to talk about, again, some of the latest things that we're seeing, I say latest really in the last several weeks, where CCRCs have grabbed the spotlight from a national standpoint. National senior living trends is probably going to be the bulk of this, and then also what's important to lenders. So what do all of you need to be focusing on, if you're looking for, it may be a refinancing, or if you're looking to get financing, whether it's through a bank or through a fixed rate bond issue, what do you need to be preparing for and thinking about? And there's some recently released documents, actually S&P released one recently just in the past 2 weeks that talk about some of that, so I'll refer to that. CCRCs in the spotlight, and I saw that one of these articles was in your packet for today's symposium, but these are some recent headlines that have been out there for CCRCs. And one which I thought was very interesting, and again, you can reference these and find all of them online, but was a recently released headline, CCRCs count as community-based care settings, care settings. Basically, the point of that was CMS very much differentiated CCRCs from institutional nursing home, which I thought was a really interesting perspective that they provide, and the article really details that and emphasizes the positive points around socialization, community engagement, which are really key elements and core elements of the quality of life that residents experience in the community. So that would definitely be one worth checking out. And from a federal standpoint, it was really a line drawn in the sand of differentiating between the two. Faith-based housing that meets evolving needs. That was a New York Times article. A number of providers throughout the country were interviewed and highlighted, not-for-profit providers, and basically talked about what they offer, the quality of life. They interviewed some residents, a really great national article on CCRCs in a positive light, because as we know, the press isn't always positive. And despite CMS's drawing the line in the sand, CCRCs can sometimes be lumped in with skilled nursing facilities, assisted living, the good, the bad, and so forth. And then the CCRC residents asked, where's the money? And that's the one that's in your packet. I think talked a lot this morning just around that entrance fee piece, and this is the lawsuit put forth by a group of residents in California against V as a corporation, taking their funds away from the community and questioning really their investment. V is a for-profit organization. So there's a little bit of that for-profit, not-for-profit, I think, thing that comes to mind when you read that article. But again, these are really, again, some recent attention-grabbing headlines from the last few weeks that have been in the news that I wanted to share. So what are we going to focus on here in terms of trends? I want to talk about the consumer, CCRC pace of growth. We do track CCRCs in the past, now, in the future. This is something that we have our pulse on from a pretty significant standpoint. For-profit development pressure and also key trends impacting CCRC from an external pressure standpoint. So we talked a lot today about the consumer. And again, I know many of you are living this and seeing this every day, but this is information that we're tracking and seeing as well. And again, it's important for all of you to go back, inform your boards, your management team, and say, how are we listening to these trends and really preparing for the future and also maintaining who we are today. So you've got this situation where so many people are talking about the baby boomers, so prepare for the baby boomers and so forth, but yet you need to obviously continue to provide a quality of life and a great experience for the non-baby boomers who are with you today. So there's a bunch of different, or a number of different stakeholder groups that really are pulling for your attention and focus, and you need to be responsive in a successful way to each of those. So silent generation, so they're called baby boomers, who may also be the adult child influencers. I know with the marketing folks and even people that are doing the feasibility studies are really taking a look at, okay, how should we be looking and quantifying the impact of the adult children decision makers? The previous speaker spoke about information. So today's consumer is much more informed and has a lot more at their fingertips than ever before. So that piece about educating the consumer and against what they may or may not be reading about CCRCs from the big picture is a key role of your sales and marketing folks. People are living longer and healthier. I'm going to show some data on life expectancy. Also going to talk about memory support services. This is a huge thing that is just a big wave against our, I should say, impacting all of senior living and long-term care services. Changing dynamics in post-acute care. Boy, healthcare reform is really having a big impact on that. And if not now, every month that goes by. I know there's still a lot of sort of wait and see how hospitals are dealing with it and what's our role, what isn't our role. But it's clearly something that you need to be preparing for and doing some things differently. Blurring the traditional CCRC continuum. It's really interesting, when you think about independent living, assisted living, skilled care, and you might have some memory support in there at one of the assisted or skilled levels. As residents are aging, maybe coming in a little later, so the average age of entry for the most part has gone up over the years, and also so has the average age of the independent living resident, and the gap between the independent living resident and assisted living resident has narrowed. As more and more CCRCs are offering home and community-based services within the residence units, you're getting a lot of, well, what really is independent? Is that person really independent, or are they assisted? And when is that their choice versus a collaborative decision-making process? So we're definitely seeing that impact providers in the continuum. So we very much know the statistics on the age wave and what is happening. So when you say, gosh, clearly the numbers are in our favor, absolutely. It's not like the numbers of 65 plus, 70 plus, 75 plus are going down. They're going up. But it's assuming you have what people want. So you can't just sit back and say, wait, hey, you know what, we can just let the numbers support us and we'll be great. You've got to meet those expectations, and the changing consumer has some pretty clear expectations as to the type of life that they want. People living longer and healthier. This is the life expectancy chart. You can see it goes back to 1950. This is published annually by the CDC. So, what is the average life expectancy for people that born in 1950 versus 2010, 2011? And you can see here that the last 2 years it didn't change a whole lot, but in that time period it has gone up pretty dramatically. And And sometimes year to year you think, gosh, you know, things don't change that much, but when you step back and take information in 5, 10, 15, 20, 30-year increments, things can be pretty dramatically different. And again, how are you planning for this, whether it's from an actuarial standpoint, programming standpoint, expansion standpoint? You've just got to be keenly aware of that. So they're living longer, but the question is, are they living longer? Healthier? Yes, no. There's been a lot of discussion around this, and there was a recent article, actually this past summer, that was called Living Longer, Living Healthier by a professor from Harvard University. And he said in here, the period of time in which we're in poor health is being compressed until just before the end of life. People are living to older ages and we're adding healthy years, not debilitated ones. Now, you could say this is contrary to some of all the statistics you're seeing on the nation's health with obesity and diabetes and so forth. But the reality is relatively speaking, people are not living, you know, 9, 10 years in really dire, extreme poor health. You know, it's really toward the last maybe 1 year or even less, maybe 2 years prior to death. So, you know, there's a lot of focus on wellness and how are you as an organization really embodying that culture of wellness. So we at Ziegler definitely pay a lot of attention to this. There are certain markets, for example, in California, most of the providers would say that it's probably within the top 4 or 5 criteria of a prospective resident what our wellness culture is. Everything from whether it's dining to, again, the feng shui of the common space to what programming you offer. And not just for residents, but for the staff. Do you embody that to policies around smoking? So if you're not on this bandwagon, I mean, the train's left the station, so see if you can hop on the train at another station, but it's really thinking through that wellness piece. Consumer expectations, and this is not just the future baby boomers, this is today as well, so I don't want to suggest that, you know, current residents aren't thinking this way as well, but again, in the CCRC sector, very much a focus on hospitality, okay, choice, so choice around, you know, amenities, activities, direction in terms of my care, so when I get to higher levels of care, the person-centered care, culture. So choice is a big part of this and residents want to have a say. Lifelong learning, again, this is part of a wellness culture as well, but how are you embodying that? Number of organizations increasingly are, whether they initially started as a CCRC in partnership with a university or college, if they did not, many are exploring some of those partnerships. It might be from a research standpoint, so maybe a research institute. There's some groups that are some providers that are joining up with different research institutes. For example, Copper Ridge in Maryland has partnered with Johns Hopkins and has a joint venture with them around just memory care, Alzheimer's, and dementia. So, but it can be research-based, it can be intergenerational learning, it can be your residents going on their campus to audit classes, to just learn, again, that lifelong learning. It's bringing them onto your campus. So I would encourage you to think about how there's some opportunities there. Technology is the norm. Technology is not an amenity. I would not say that it is a selling point, it is an expectation. So if you do not have wireless in most, if not all of your common areas, you need to be thinking about that. So just really the financial and capital investment in technology from an infrastructure operations standpoint, but also care coordination standpoint, is increasingly the norm, and those that are at a higher level, it's a differentiator. Spoke about wellness, and then we're continuing into retirement. We have this visual down here that just shows really, you know, the adult years where people start and then where they go in terms of education, work, leisure. And again, the education doesn't stop, the work doesn't stop, and maybe the leisure increases a little bit more, we hope, right? Reinventing retirement. If you Google 80 is the new 65, reinventing retirement, do it one of these days and see what pops up. So these are pretty much mostly all books and organizations that have nothing to do with senior care and senior housing and senior living. There are a lot of organizations and authors and retailers out there that are very much focused on again, this age cohort. So it's don't retire, reinvent yourself. Reinventing retirement, retirement with a big red line across it. So talking a little bit about the name piece. Steve, I wasn't here for your presentation. Did you get into that? So clearly, using the word retirement and care is not something that bodes well for future residents and consumers. So it's really rethinking that. And I got to tell you, it's one of the things that I pay attention to. And we regularly get marketing packets or packets of information on maybe the wellness program at a CCRC. And I pay attention to how many organizations are removing the word retirement, the word CCRC, and increasingly more and more. There's some CCRCs that you'll talk to, they say, we haven't used the word CCRC in 10 years. And again, there's going to be a trickle down for that without a doubt. And at Ziegler, when we think, gosh, everything from the rating agencies to, there's a lot of things that are around that CCRC name. You know what? When the name changes, it will happen and everybody will adjust. So call it potato, whatever. The bigger picture, rating agencies and financiers, are not as concerned about that. They're concerned with you being relevant and viable. So moving on from the independent living resident of today and tomorrow, it's really focusing on assisted living. In 2013, the estimated cost of Alzheimer's care was $203 billion. When you look at global statistics for this, it will blow your mind. So with the people living longer, you're also seeing increased incidence in a lot of the dementia and Alzheimer's. There is an annual publication that's put out by the Alzheimer's Association. It's called the Annual Facts and Figures. So this information comes from their 2013 publication. I would encourage you to get it. You can go on their website and just download it. But this shows even some regional breakouts of the projected changes between 2000 and 2015 in Alzheimer's prevalence by state. And you can see that Florida is on the higher end of that. Now that has to do with age and a number of different factors, but the point being, this is a force that is really impacting all of you from a provider standpoint, but the country even in terms of caregiving. So when you think about today's baby boomers, so we're thinking about them in terms of, okay, they're tomorrow's resident, they're also today's caregivers. And the statistic that the Alzheimer's Association looks at is that caregiver support ratio, and clearly as the years progress and the boomers get older, that ratio goes down. So it's the question of who's going to provide support for them as they need it. The other interesting piece to think about is we held a conference in Phoenix back at the end of February, and we had a real estate researcher come in and speak, which was very interesting just to see it from a very different lens. We all pay attention to the real estate trends, maybe Case-Shiller Index and so forth. And she autopsied the real estate market in a very different way. Well, one of the things that she pointed out with the baby boomers is not only are these people maybe caring for their parents, their aging parents, who else is living with them? Their kids. Grandkids. And grandkids. So there's so much really on that age group that is really, quite frankly, impacting all of you. So maybe, with the recent years with the recession, their kids may graduated from college, couldn't find a job, maybe lost their house, moved back home. So it's, there's going to be some pretty dramatic things once that group of baby boomers is no longer really, has the ability to support and care for, the parents and the children. These are some statistics. We track the NIC data, the NIC map. So NIC, National Investment Center, for those of you who do not get NIC data, I would encourage you to explore potential subscriptions. Not cheap, but they track occupancy. So when Ziegler releases the CCRC occupancy figures, that's where we get it. They do very market-specific information, so they track construction and so forth. For those of you who really want to understand your market and what's going on, not just from the not-for-profit standpoint, but from the for-profit, I'd explore NIC. This shows through the end of 2013 the construction, and you can see it's not differentiated real clearly here, but that top line that's going way up, and up, that's freestanding memory care. That is not the not-for-profits, that is the for-profits building freestanding memory care. Now we know that what we're seeing at Ziegler in terms of the new construction and repositioning, that we're seeing a lot of organizations and providers CCRCs that are maybe repositioning skilled nursing units to a less institutionalized, maybe more neighborhood model, adding memory support units, and then maybe some independent living as well. But we're seeing that focus shift in the continuum as well. Skilled care, again, increasing demand for this short stay care. We have some CCRCs that we know that are, actually have, from a physical separation stand, have very much separate buildings, separated the short stay skilled nursing residents from the long term. And again, this is where the healthcare reform piece has a really big component to it. So it's a significant influencer to this. And again, it's understanding for the CCRCs, if you are in a market where there's an ACO or a certain level of agreement, if one of your independent living residents, let's say, needs to go in the hospital, you need to know whether they can come back to you. That is a big unknown question, a big question that you should be asking your local healthcare providers, because that's something that is up in the air and to be figured out, quite frankly. So again, the skilled care, we're seeing a lot greater trend toward the household models, the small neighborhoods, less institutional. Last week or 2 weeks ago, and I actually have not heard back results from it, Action Pact, again, big culture change around person-centered care and so forth, had a one-day symposium in Wisconsin all around the financial model of small houses, because one of the big pieces that you hear about greenhouses and small houses is that they're expensive to build. So they held a one-day symposium all around the ROI. So okay, here's what they cost, but here's what you get in return. Actually, their CFO ran the whole day symposium. So I know Ziegler had 2 staff there, and I haven't heard anything about it. I don't know if anyone from Leading Age went, but some of those organizations that are very much pushing, again, the small house, the greenhouse models and design concepts are paying attention to some of the things that people have put forward in terms of just the expense around that. So those are some of the consumer trends. I want to talk about CCRCs. So in 2009, Ziegler published a national CCRC listing, so quantified every CCRC in the country, and we are looking to do that again later in 2014. So we track that. We not only track what is currently built, we track what is under construction, what is even at the concept stage, where, who, when, what, how big, all of that. So I can tell you that in the last 3 years, obviously things slowed down. That's not earth-shattering to anyone, but we are seeing an uptick in terms of the number of new physical locations. There have been 21 new purpose-built CCRCs. We use the terminology purpose-built versus non-purpose-built, purpose-built being from the ground up. We are building a CCRC. The non-purpose-built would be CCRCs that evolve. So let's say you were a nursing home and we added assisted living and independent living. The other point to mention here is Ziegler's definition of a CCRC is having independent living and skilled nursing on the same campus.
And not necessarily an entrance fee.
Correct, not necessarily an entrance fee. So states vary in terms of their definition of CCRC. California's is different than Florida's, than Pennsylvania's, and but that's been our pretty consistent definition and what our publication backs up. So you can see that of the majority of new purpose-built CCRCs, most have been from existing organizations. What you're not really seeing a whole lot of is a brand new not-for-profit come out of the works. Some, but mostly it's been from existing organizations. Now, the Sinai Residences here in Florida is an example of a newer CCRC organization coming up out of the roots through the Jewish Federation. But they do not have dozens of CCRCs throughout the state or country. So you can see here, again, primarily between 200-300 units, not generally seeing the large 500, 600, 700, 1,100 units. Even the latest Erickson CCRC, which is under construction now in New Jersey, is a much smaller footprint than what they've had historically. So it's around 200-300 units compared to 1,000 plus in most of their CCRCs. This is largely not-for-profits. The for-profits who are building CCRCs, which there aren't a ton, they're building the independent living rentals and freestanding assisted living and memory care. Those that are building CCRCs, it's almost all purely rental. CCRCs. There is one for-profit Kisco that's building an entry fee CCRC in North Carolina, but it's primarily rental CCRCs that the for-profits make. So this just shows, again, the pace of growth. This information is from the LZ 100 publication. It's the Leading Age Ziegler 100, the 100 largest not-for-profit system providers in the country. This is the aggregated data. When you look from 2000 to 2012, you can see here the growth in terms of the CCRC, which is the yellow, and fairly stable from 2011 to 2012. Again, we're collecting the end of year 2013 data now. The other important piece to note, these are all market rate CCRCs. 54% of the LZ 100 is all for affordable housing. So whether that's affordable housing on the campus of the CCRC, or they have separate affordable housing properties that they own and manage. I do know that there's some CCRCs that are looking at a mixed market rate housing. There's one that we were speaking with last week actually that is a CCRC. It's a nursing home now, and they have a lot of acreage, and they are expanding and added independent living market rate units, but also going to do some tax credit housing as well. 1921, that's the magic number. So that is the latest number of CCRCs for-profit and not-for-profit throughout the country. Again, we'll be releasing the updated document later this year. There's the breakdown by state. Florida's the 5th largest state in the country for CCRCs. Pennsylvania is number 1 with almost 200. And here you can see the unit breakdown. You know, the vast majority between 200, roughly 100, 200, 200 to 300 units in that range. This is the national listing by year. You can see the big peak year in the CCRC growth was 1985 to 1989. And then we saw that dip from 2010 to 2014. That estimate for the number of new CCRCs in that 5-year period from 2010 through the end of this year, that's pretty solid. So we know what CCRCs are really going to open by the end of this year. And same thing with those projections through 2019. We track and know that that's a pretty viable number. This is a list. There is one missing from this in North Carolina. The for-profit CCRC by Kisco that I mentioned is not included in here. However, this shows you the new CCRCs that we anticipate will open by the end of 2015. Now, some of these may get pushed back. For example, you can see in Maryland, there are a couple states where it can be difficult to develop new CCRCs, bring new CCRCs to the market, whether it's a state regulatory environment, whether it's maybe a non-CCRC friendly state just from even the local level. But Maryland is a tricky CCRC state. Pretty much the only people building in Maryland right now are existing Maryland providers. Nobody else wants to come in. So
why is that?
Because there's a great deal of resistance just to CCRCs really in general at the state level, not terribly receptive to CCRC development. And there's also, for example, Evamar there in Bel Air, Maryland, they have been trying to build a CCRC on this tract of land and are getting so much resistance just from the residents in the surrounding communities, where Pennsylvania is the complete opposite. Pennsylvania is like, yep, bring the CCRCs on, that's good by us. So,
you know, the numbers you're giving seem to be small. I'm just wondering, in Florida, where you had 105, you know, when we tried, at one point in time, there was, I can't remember what kind of regulatory issue, but we were trying to figure out how many providers, other than those regulated by Chapter 651, provide the full continuum of care. We weren't able to come up with that in any specific way. We did a guess. So how can you, since most of the others are not really regulated except for a portion of the community, how do you come up with your estimates?
We have probably a dozen sources that we have our national CCRC listing from. So when it was initially started, it's everything from going to each state and saying, okay, you know, what's the state listing, to NIC has a listing of CCRCs, National Investment Center, to closings we've done, to all the official statements. So any new CCRC that was built is going to have an official statement. I mean, there are so many resources out there.
The other thing too is when this was started, and they released that. I participated in something, and it literally took 2 years to come up with this data for that exact reason. Is they went as far as, you know, looking at who are all the licensed nursing homes, and
Right.
then looking at where they were at. Did they have some kind of a campus affiliation? So they looked at it from lots of different ways. I'd be willing to bet that there may be a few that slipped through
Sure.
because it is so definitionally hard to decide. But I'm pretty comfortable with that being a pretty accurate number, plus or minus just a few.
Yeah. And every now and then there's one we miss. For example, you know, one of them that I've added in the 1921 is the Catholic organizations, primary nursing home, assisted living, and I think they added like 6 independent living apartments. Per our definition, that's a CCRC. Now you could have, you know, debates over is that sort of the CCRC or not, but it's a very exhaustive process. And one of the things that we'll be doing with the update for the 2014 is we go through all 1921 and we are going to verify them. Are they still under the same ownership? Because in the for-profit world, they're being sold left and right. There's certainly some of that consolidation in the not-for-profit world. We do unit counts where we have it, a whole number, are they entry fee, are they rental, and so forth. So it's a very tedious process. And we also, how we track future, we pay attention to all the media outlets. So we watch a whole group of different daily sources that come through, and you know, so I have a listing above and beyond the 19 new that we're envisioning by the end of 2015. There's another 39 that I'm currently tracking that we know are being discussed. The newest one is, and it was actually just in today's Senior Housing News or the other week, the Archdiocese of Philadelphia is planning a CCRC. That'll be the first new CCRC in the Philly area, which is a very saturated market since I think the 2 newer Erickson communities. So not-for-profit CCRC growth, again, most growth we're going to see is expansion. We'll see some expansion to new physical locations, but also through the consolidation. And single sites that are growing into systems looking to expand, and some potential single sites. So this is some LZ100 information as well. The red line is the total number of the unit count growth that we've seen over the years, attributable to new campuses, so brand new bricks and mortar. The yellow is what we're going to see, what we've seen and what we project to be seen in terms of the consolidation. So that can be 2 organizations that are single sites coming together. These are some examples of what we've seen. This isn't everybody. You know, consolidation is not for everyone, so we want to be clear about that, but it's a trend that's not just happening in senior living, it is happening in home health, it is happening in the hospital world. I mean, the day of the freestanding community hospital really is not around anymore, and every week it's dozens that are consolidating. So it's pretty universal throughout a number of different sectors. So an example, Winchester Gardens, retiring CEO, very healthy CCRC in northern New Jersey. You know, part of the planning for his departure was working through the board about longevity and success. And I think he had been with them 30-some years. They ended up joining Spring Point Senior Living, a multi-site provider in New Jersey. Again, it was not a hand raising, it's not we're in trouble. It was, you know, a healthy organization joining a larger one for future planning. Blue Stem Communities, that is 2 single site organizations that were in Kansas. Both said, hey, let's come together, we can be stronger together. They actually also got a multi-county contract for PACE that they say very clearly we would not have gotten alone independently. Vinecroft and Heritage. Vinecroft was the CCRC that was feeling like, you know what, we're struggling with maybe some occupancy issues. I think we really need to partner with someone else, and they joined Heritage Ministries. So these are some recent examples that occurred in the last year and a half. So again, CCRC growth, actually the number's up to 39 potential new CCRCs. We're seeing strategic planning activity gaining momentum. Ziegler's doing tons of strategic planning. We know the consultants in the industry are very busy with boards and management really asking the right questions. There are high barriers to building a new CCRC. It is not cheap. So the for-profits have tons of money to be building the IL rental, the freestanding assisted living, and memory care. The entry fee CCRC is a much bigger undertaking. So it takes a good bit of work and planning. For-profit development pressure. For-profits have very easy access to capital right now. So I'm going to show a few slides that they're the top 10 for-profit owners of senior housing. They continue to grow, but what we're seeing the most growth in, quite frankly, is really that the more regional operators that maybe own a handful of communities that are looking to expand. And so it's the small to mid-sized operators in certain metro or regional markets where we're seeing a lot of the growth. And it's a real estate market. They're investing, they want to get a return, and they will sell. That's really the business model for it. Again, they're not necessarily seeking capital for the CCRCs. These are the 10 largest the 10 largest for-profit senior living providers. And again, we just share this with you because we want you to be very well aware of the pressure the for-profit market is having on your CCRC. Even if they are not building CCRCs, the very, very fast pace of growth in the for-profit market right now is eating away at the supply and demand. It is absolutely impacting that at the local level, because I can tell you, like it or not, many residents do not know the difference between the for-profit and the not-for-profit. And again, if there's so much supply in a certain area, whether it's an IL rental or freestanding assisted living facility, it is impacting you. So you can see here, and real estate investment trusts are a big part of this, and the asterisk is for Brookdale and Emeritus, who recently announced a merger. And they will quickly jump to number 1. So look at this. This was what was happening during this time, 2008, 2009, 2010. Those were not pretty years. We're glad to have them behind us, right? Well, they had 1 year where they dipped. And again, this is the largest 10, and they've been growing ever since. So they took a kick in the gut, but they rebounded pretty quickly and have had 47%, almost 50% growth. So again, this is just a little bit of a wake-up call, just in terms of how they're impacting you. These are total units of for-profit, not-for-profit. We know that the CCRCs continue to predominantly be not-for-profit. Memory care. There are very few not-for-profit freestanding memory care facilities. And then again, this just shows the number of new properties and expansions at the end of 2013. So at the end of 2013, there were 120 new properties in the for-profit market under construction, 120 compared to 6 among the not-for-profits. So what are some of the key trends? I talked about centers for excellence, university-affiliated CCRCs. Again, this is a great opportunity for some joint venture. Explore and see, again, how that potential partnership can really raise the bar for your CCRC. And again, it's redefining, repositioning, not to catch up, but is to be a leader in your market. Healthy living community, is CCRC the right name? Lifestyle management. Is something that we've heard for some of the technologies around care coordination and so forth. So it's redefining your CCRC and thinking differently. Technology being a game changer,
Why do you think that there's been so little development in the nonprofit? Is it access to capital, or what is it?
The not-for-profit developers or not-for-profit providers, again, the stronghold is in the CCRC market, and that was most impacted by the real estate market. So I think it's the really strong correlation there between the real estate market and people's ability to sell their home, and also the CCRC piece. So occupancies took a hit. We're seeing that uptick, and in the last week, last 2 weeks, I've spoken to more providers that say, hey, we're at 97 to 100% occupancy. So many CCRCs have recovered, if not gained more. There's some regional differences clearly with that. But the thing to build new CCRCs is a very significant cash expenditure compared to building an IL rental.
Yeah. The other thing too is that CCRCs and particularly not-for-profit, it is difficult, and they're in it for the long term. The independent IL and the memory care is still really a real estate based process. They expect to buy and sell those every 5 to 7 years. So they put a limited amount of capital in, leverage that capital, run it for a while. Usually a REIT or somebody owns it, and somebody manages it, and then in 4 or 5 years, they sell it and get their money out and put it in something
Right.
else. So it's a market, it's a real estate.
It's a churn.
market, a churn, as opposed to a CCRC, which is for the long term, which means they have to go through a lot more planning.
Right.
And much more reluctant to just jump
Right.
into a market because they're committed for many tens of millions of dollars.
Right. The other thing too is generally once that for-profit then sells, so it's often maybe around the time that the community might need some investment. So it sells and then the new owner then obviously puts some cash into it, invests it, and you've got, you know, a nice shiny new community look. And so that's very much the real estate approach that they take. I know Steve talked about technology. It's, again, something that we very much track, investment in technology. At our CFO workshop next week, we'll have Majal Wan with Cass Leading Age sharing results of a CFO hotline survey that we did recently on technology expenditures. So we are seeing more provider organizations spend, you know, invest in technology compared to 2 years ago, the last time we did the study. But there's a huge question in terms of how much. And it's the keeping up because it's changing so quickly. And again, these are some great opportunities for some joint ventures. I think a very valid question with all of you is to say, you know what, maybe we don't need to be the end all be all with all this. There's technology firms and organizations, maybe it's a home health agency that has this technology, and how about we just partner up with them instead of trying to grow it organically ourselves. Just want to mention, this is a fund that Ziegler is backing and managing, where it's provider based, so all the investors are not-for-profit providers, so many of your peers. There is a fund where we will be investing in organizations, so it's a private equity fund. We'll be investing in for-profit, probably largely technology companies, some care coordination companies, all around aging. So technologies for long-term care, aging, care coordination. So it will be fun to watch this and just strategically see what, as an industry, we all learn from that. I think healthcare reform has been covered as well. Again, ask questions, know what's happening in your local markets. But the point that I would emphasize there is the data. You've got to know your outcomes. You've got to know your costs. Factors. The patient-resident satisfaction, for those of you who don't know it, in the hospital world, that is public. You can see what the hospital down the road scored compared to you. I can tell you that it is coming for public resident satisfaction, patient satisfaction in skilled nursing. CMS already has a tool for it. Right now, the only barrier is the cost of implementing it, which is expensive, but the program's called CAPS. It's the same as the hospital one. They have a home health one now if you have a home health agency. So you must do the satisfaction and you report it to them, and then they in turn release it publicly. We do define growth in many ways. We're seeing a lot of growth, obviously, in not just the bricks and mortar, but home community-based services, joint ventures. A number of your peers, and maybe some of you in the room, have your own for-profit arms. There are a number of CCRC organizations that maybe have a development, a consulting, or IT. The two big strong examples of that are Provinet, which is part of Providence Life Services. They have millions of dollars every year in revenue on just their IT consulting and outsourcing, and Asbury Communities in Maryland. HCBS, I want to be sensitive to time here, so I'm going to go through these pretty quickly, but you can see just some specifics here. I can tell you that this is one of the most common joint ventures we're seeing. A lot of providers are engaging in a former joint venture with home health agencies, or maybe they have some ownership as well. Continuing care at home, or CCRC without walls. Clifton Larson Allen, Sarah Spellman from CLA is a big proponent of this and focus on that. We know Leading Age is really trying to solidify this group and bring them together from a learning standpoint, but more and more organizations are exploring the CCRC contract beyond the bricks and mortar. PACE, we're seeing that significantly increase, and again, there are a number of JVs around PACE too, so that's something that we're seeing, and this can be a size matters type of thing. I use the Blue STEM communities where they just got a multi-county PACE contract. So partnerships and joint ventures, fostering innovation, economies of scale, pooling capital and sharing risk, responding to increasing demands around technology. Just being able to invest in all that technology is difficult for any one organization. So partnerships can assist with that. This is preliminary data for the LZ100 that I ran about 2-3 weeks ago. We'll have the final data in our full report when it comes out this summer. But these are common joint venture examples that the LZ100 organizations are engaging in. Pharmacy, we're seeing a lot of pharmacy, joint ventures, hospice, home health. And these are just some examples from Kentucky. That's actually dialysis that they have on one of their campuses, and they've partnered with a medical care group there. Bottom left is a home health joint venture, for-profit Blackstone, then also ownership with Life Enriching Communities and Episcopal Retirement Communities in the Cincinnati market, St. John's in Montana, Presbyterian Senior Living with Jedco in Baltimore. So what's important to lenders? Going to wrap up here. Obviously, lenders it may be institutional purchasers of bonds, banks, rating agencies. So paying attention to a number of different things that were discussed. So obviously strong financials and operations, that isn't obvious, but we say plan ahead. Some organizations come to us and say, okay, we're ready to go, and you got to back up a little bit because you've got to be strong going in and thinking through all of that. Governance does matter. If you're having tons of turnover in your board and with your leadership team, they're going to pay attention to that. So looking at how solid your board is. Proactive behavior by the organization, I know, can definitely help with rating agencies. Have you committed to trying to keep up with your physical plant? Doing things to be proactive with your marketing and your occupancy. They like to see that. That investment in the physical plant and infrastructure, clearly you can see that has a direct impact on occupancy and is something that organizations pay attention to that are lending. Strong record of track record of performance obviously is important, and size can definitely matter here. So just the financial investment, what's happening with some organizations, they know they need to invest, they do not have the capital or ability to borrow capital, and that's when they're maybe turning to some other organizations. The one piece that is not on here that I'll mention, and I would encourage you to Google this. We're actually going to have it in our Z News for this week. We have a recommended rating list. S&P just released their position on alternative types of debt and how that impacts ratings. So basically there's so much bank lending going on right now because the interest rates are so favorable around that. So this details how they look at it, and bottom line is they want to know about it from a rating standpoint. If you also have bond debt, they want to know about it. You need to be transparent about it, and it can impact it, good or bad. So I would encourage you to check out that document, and we'll have that again in our Z News. If you're not on our Z News distribution list, let me know and we can get you added. Ratios and trends, physical plant, I think that was touched on earlier. This is from the CARF CCAC ratios. Days cash on hand, again, these are all things that your lenders are going to look at. Net operating margin ratio, adjusted for entrance fees, and then the occupancy. So the good news is the not-for-profit occupancy for CCRCs is consistently better from the for-profits, and throughout the difficult times of recent years, we have seen that gap remain, if not get bigger. So I'm going to wrap up at this point with a quote: if opportunity doesn't knock, build a door. The days of sitting back and having people come to you and say, help us, we need you to build new, or this church congregation wants you to support them with a new facility or programming. That's really not happening at all. So you need to be proactive with going out, expanding your mission, and saying how can we be as strong as we can. I think I went a little over. I know, that was a lot of information. Questions, comments? Okay, thank you.